Join us. You've retained India's rating for now and affirmed the outlook going forward. Just put this into context for us, Andrew. You've talked about a continued eye on reforms and how this will really continue to mold India's story, as we move ahead. There have been certain other agencies that have cited disappointment in the way India has handled the crisis so far. What leads you to be more confident on the way forward?
Sure. Thanks for having me. Look, I think that going forward, we absolutely do see a variety of risks to the Indian economy. We're forecasting for real GDP growth to fall by 5% this year, and we expect the fiscal deficit to be 11% of GDP. So these are some stark figures, and India is facing a difficult period, as is much of the rest of the world right now. Now, these risks to the economy are probably going to be, concentrated in a few areas. The state of the labor markets, very difficult right now. The state of the banking sector has become more difficult again and may continue to be that way for the next 12 months or so. NBFIs are also facing stress, especially those which are a little bit less creditworthy than their higher rated peers. So we see these risks to the economy, but at the same time, we expect a strong recovery next year. So we're forecasting real GDP growth to come back up to 8.5% in fiscal 22, followed by a stabilization in the economy to about 6.5% or 7% growth in the years beyond that. We do see some promise in the government's reform measures as well. So it's notable that under the guise of this large economic stimulus package, which was introduced by the Prime Minister some weeks ago, we had support which was labeled as being 10% of GDP. The direct fiscal expenditure, of course, much lower than that, but a wide variety of other measures, especially to help the banks, to help the MDFIs, and to help the discoms, as well as MSMEs. But beyond that, we saw reforms to the MSME sector in particular, as well as to labor markets in certain states, which is promising and encouraging. For us, we believe that more flexibility in India's labor markets could help to drive investment from the private sector, both domestically and from international investors going forward as well. And we also saw some important reforms to the agricultural sector domestically. So if the government, in our opinion, is able to continue to deliver on these reforms going forward, then we see, again, a strong recovery starting in fiscal 22.
The affirmation, Andrew, comes as a huge relief, of course, for the economy, given what we're going through right now, and given the slew of measures that the government has released to try and nurse the economy back to health. But there is a strong lobby also for further spending to bridge that fiscal deficit. One side of the market, or thinkers that believe that is the only thing that will really get the economy moving again. What would you say? How would you counter that? That lobby really that's in the market.
Sure. Well, in our opinion right now, we believe that the Indian economy retains the organic factors which can allow it to recover over time, and again, to some extent beginning next year, without probably the introduction of more aggressive fiscal measures from the government. Now, that being said, what I think we've seen so far is a pretty conservative effort from the government. Note again that their direct expenditure measures under this larger fiscal stimulus package are, in fact, quite minimal in a sense, at around 1% of GDP. So I think that, to be honest, the government comes into this year with relatively significant fiscal constraints, right? The Indian government has been running elevated fiscal deficits for a long period of time, and its debt stock, by our calculations, was above 70% of GDP on a net basis to begin with. Now, that debt stock is going above 80% of GDP. So they are keeping in mind, it appears, the sustainability of their public finances, of their fiscal program, while at the same time trying to provide support to those sectors which are feeling the most acute stress. That appears to be the way forward for the time being. if there's additional fiscal measures that are announced, going forward, I think we'd take that into account on a case-by-case basis.
Okay. On the kind of growth trajectory that we may see, let's say in the next year or two, given what you've just described, do you feel that we're going to be as badly hit as the rest of the world, or that India may actually come off just a bit better?
Sure. So in fact, right now, I'd characterize this -5% forecast of ours for India as being a very difficult one. This is a very deep contraction, and it's probably a bit deeper than what we're forecasting in a lot of other emerging markets around the world, and certainly a bit deeper than what we're forecasting for some EMs in Asia right now. The reasons for this are essentially because the government introduced very strict containment measures against the virus beginning in March. And for the most part, these were carried over all the way until the end of May, and perhaps the last week or so as well. Now we're seeing a gradual, or perhaps an increasingly faster opening up, a reopening of the economy. But for every month that these measures are in place, we consider there to be quite significant downward pressure on the economy, and of course, a significant amount of activity is not taking place. So that was really I think the key development that led us to revise lower India's real GDP growth forecast for this year. But that's not to say that, of course, the promise of the Indian economy and its ability to return to its trend rate of growth, which again we see as being between 6.5% and 7% per year, is permanently damaged. We don't feel that there's been such permanent structural damage done to the economy at this point in time. We just feel that it's going to be a period of healing and recovery at a gradual rate in the economy throughout the rest of this fiscal year, and then picking up steam and accelerating in fiscal 22.
Okay. Andrew, just a note on the risks, and again, I mean, you touched upon it, but when we're looking at, at the financial sector, and I'd assume that's the biggest red flag, any concerns, with regards to the NPA issues, for example, or financial sector reforms, that continue to be at the fore? How would you outline some of the risks that you perceive on that front?
Sure, absolutely. So, the Indian economy has been running parallel against the banking sector, which has had significant problems over the past few years. But at the same time, the introduction of IBC a few years back has helped the banking sector to begin to address its problems and its problematic assets in particular. And we started to see improvements in asset quality, especially through to the end of 2019 and into the beginning of 2020. So in our opinion, that trend probably would have continued if it had not been for the exogenous shock wrought by the pandemic. So now we're in a scenario where, unfortunately, the banking sector does enter this crisis from a relatively weak footing. What that means is this healing process, this improvement that we're beginning to see there, is probably going to be pushed out. It's probably going to be delayed to some extent, perhaps 12 to 18 months. We've also seen the suspension, of course, of IBC for a period of 6 to 12 months. So, unfortunately, this is going to, I think, push out where we're going to see the most progress in the banking sector. And going forward also, I think a concern of ours could be, what is the banking sector's ability to support the economy's recovery? But on the whole, and again, on a more medium to long-term basis, we do feel that there's been constructive steps taken by the regulator and taken by the government as well towards addressing these issues in the banking sector, and that eventually these will bear fruit.
Great, Andrew. Great talking to you today. Thanks so much for joining us and taking us through your latest view and rating on India.
Thank you. Thanks very much.
All right, markets this afternoon, as I mentioned. All right, we're continuing